All right. Hello again, everybody. This is Mike Rixey. I am the lead options instructor for NetPicks, and this is our weekly options recap. I wanted to jump on here today, walk you through a couple of trades that we've closed out here today. Mixed bag on our overnight pop trades. We had a winner and a loser today, so I'll talk through those in more detail. I'll also take a look at a couple of new trades that are setting up for us next week. I think there's a tremendous opportunity here in the near term. We're at all-time highs here at a very overbought extreme. I think that's going to give us some good activity here in the weeks to come. So we'll talk about those trades in just a moment. As always, if you have questions here at any point during the session today, feel free to type those into the chat. Or if you're watching the recording, you can always email me directly, mike@netpicks.com. So let's talk about market big picture. We've been talking about overbought conditions now for the last number of weeks, but we continue to see this grind higher continue. One of the more impressive moves that we have seen in a long, long time. I mean, you take a look, it's been impressive now for the last 12 months, really since COVID really took off last year. We have seen this move higher continue, really unbelievably so, because we continue to see very mixed numbers, economically, worldwide. But then also you take a look at the inflation numbers starting to kick up, what we're seeing over in the bond market, what you're starting to see over in the crypto markets as well. We just have markets that have just been so one directional for months. It's been amazing that we just have seen this move continue. So the last 2-3 weeks here on SPY has really been icing on the cake. I mean, we've had a strong uptrend in place, and we've gone from, every dip that we do get for a day or two is bought up immediately to now we just don't get any dips. I mean, even intraday, it's just been there's been very little price action on the downside for any length of time. The new all-time high here on the high of the session today at 417.89. That is our line in the sand here currently. Obviously, we still have a couple hours to go in the session. We could very well see an afternoon rally back up to those highs and potentially take out those highs. The last couple of Fridays, we have seen those late day afternoon rallies. So we'll see if we get another one here today. What's been fueling the rally? Obviously, we have all the stimulus that's been thrown at this market. I mean, literally trillions of dollars thrown at the market. We've got interest rates at all-time lows. So you've got a lot of factors coming into play. But what's interesting is, throwing all of that to the side, let's talk about the technical perspective. Price is certainly strong. We just talked about that. But let's take a look under the hood a little bit more. Some things that I have noticed here over the past week or so. Volume has certainly contracted. We've seen volume struggling to hit 50 million shares on a daily basis. That's well off of the levels that we were seeing back in March and back late February, where we are well above 100 million shares on a regular basis. We have seen the volume contract. Here we are on monthly expiration. The April options expire today. Normally, that's a very high volume session, and it very well might be here this afternoon if we get an active last hour of the day. But on a monthly expiration day, to be sitting at almost 1:30 Eastern time and to only have 36 million shares trade, I mean, it's a very light number. Very typical of a late stage move. Everybody that wants to be long is already long. No one wants to sell because, as I mentioned, there's been no downside pressure at all. So we're left in this low volume drift mode. And it's been that way all week. It's been very slow conditions intraday, but because volume has been so light, that's typically an environment where the bulls take over and they continue to be in firm control of this market. Look what's happening with the ATR down at the bottom. The average true range, we've talked about this the last few weeks. We have been in a steady downtrend since really early March, where we are up above 6.5 or so on the ATR. We have moved down below 4 as of today. We have seen intraday range really contract. We've seen it today, and I'll show you the 5-minute chart in just a moment. You'll see it visually. The range has certainly contracted. There's not as much activity back and forth. We want activity. We want the back and forth movement as active traders. If we're going to get that back, if we're going to get the ATR to tick upwards here over the next week or two, we absolutely need to see some selling. We just can't continue to head higher every single day. We need to see some healthy selling. I'm not looking for the market to collapse. I'm not looking for a crash. That's not it at all. We just need a healthy pullback that would offset, some of these overbought conditions and start to reset things for the next wave potentially to the upside. So areas of resistance up above. Next area is going to be 418. 418.50, and 419. Those are the big 0.50 levels and the 0.00 levels. Typically, those big round numbers will act as support and resistance, so we'll watch those on the upside. The first area that we want to see broken on the downside is the 8-period exponential moving average. It's currently sitting at 411.60. Very unusual to go this length. It's been a couple of weeks now without that 8 EMA being tested. That 8-period exponential moving average is a very short-term moving average. If price action breaks away from that level, it'll typically only do so for a couple days at a time. We're not going on over 2 weeks in a row where price has been above that level. Very unusual. Typically, when we see that type of a stretch, you'll get a pullback in the very near future. So that's what we're looking for going into next week. If that level holds as support, we could very well see another leg back to the upside. But if it breaks, we've got a nice cushion down to the 20-period moving averages. Both the simple and the exponential moving averages are the green lines there on the chart. Down around 402 and around 404.5. Those would be the next areas of support should we get any type of a move lower. Now, it seems like a long shot with this market higher every single day, but those are some levels that we're watching on the downside. So I mentioned a volumes light. I mentioned the ATR continues to contract, but look at what we're seeing intraday. Let me load up these charts as well. The lower right-hand corner, this is the 5-minute chart of SPY. And let me go ahead and load this up. I'll zoom in here. The 5-minute chart, I mean, if you go back into February, March, we were seeing pretty big moves back and forth. There was a lot of good range to work with. Look what's happened here so far today. The market opened. We saw one brief sell-off during the first 30 minutes of the session. Since then, we have rallied up, and we've basically spent the rest of the session with price action just hugging the VWAP, or the volume-weighted average price. That's that solid blue line there. We just continue to chop sideways in a very tight range. Very typical of a late-stage move, I would say. Because again, I don't know many people are looking to throw money at this market on the bullish side at this point for the first time. Everybody that wants to be bullish has already put their capital to work. But no one wants to sell because there's been no pressure on the downside at all. So we're just kind of left in this sideways pattern that we know will break. Okay, we know that this type of sideways pattern it doesn't typically last very long. Going into next week, this is the coiled spring pattern that we've talked about previously. Markets that don't like to stay quiet for long, when they get into these sideways patterns, at some point that spring that continues to coil tighter and tighter, it's going to want to pop. We just don't know when that's going to happen, nor do we know in which direction it's going to happen in. For our sake, for the sake of active traders all over, I hope that it's to the downside, because that would just open things up for us. It would give us better price action to work with. In the upper left-hand corner, I have my volume ratio numbers here for both the New York Stock Exchange and the NASDAQ. The volume ratio on the NYSE, slightly positive, 1.33 to 1 positive. On the NASDAQ, slightly negative, minus 1.27 to 1 on the negative side. So volume very mixed. Again, another sign of a late stage move. Doesn't mean anything as of yet, right? We need to see some price action confirmed first, but the volume picture, very, very mixed. The advanced decline line on the NASDAQ is sitting at minus 980. There are more stocks moving to the downside than the upside in the NASDAQ. So even though the NASDAQ is down a few points, under the hood, I mean, there's more weakness than the initial numbers are telling us. I mean, you take a look at, an advanced decline line at minus 1,000. There's more selling going on here. The issue is you've got Amazon up 10. You've got some of those tech stocks. You've got Microsoft up. You've got some of those tech stocks that remain pretty strong. And those are really covering up some of the weakness in those other areas. The advanced decline line on the NYSE or the New York Stock Exchange, very similar story. Even though we have the Dow up 100, we've got the S&P up 8. There's actually more names in the New York Stock Exchange moving lower than higher on the session. That number is currently at minus 80. Very mixed internals, very typical of a late stage move. Again, I am not trying to, I'm not trying to say the market is going to move lower immediately, but I'm just showing you some of these warning signals that are out there. Ultimately we need price action to confirm, and it hasn't yet, but there are definitely, there's definitely warning signals being flashed in my opinion. In the lower left-hand corner, the NYSE tick, it just tells us at that very moment in time, how many stocks are trading on an uptick versus how many stocks are trading on a downtick. And what I'm looking for here is extremes. An extreme on the upside is above plus 1,000. An extreme on the downside is below minus 1,000. We have not had any type of extreme here today, and we've had very few extremes so far this week. Those extremes indicate buy and sell programs kicking in. We haven't had any buy or sell programs so far today. Again, another sign of a market that's already made a heck of a run. There hasn't been any buy programs so far today because this market's been up, 3 weeks in a row. So there's a lot of traders getting a little bit more cautious. Again, not saying, there's a massive run for the exits yet. We're just not seeing that price wise. But I do think what we're seeing here on the internals, I think it definitely shows some signs that it's time to potentially book some profits if you've been bullish, or if you've got capital to put to work, potentially look at some neutral to bearish positions, or potentially to look at some hedging positions as well, just in case we do get that pullback here going into next week. So based on all of that, based on some of the warning signals that we've seen, based on price action being so incredibly overbought, what we did yesterday afternoon, we put on a couple of overnight pop trades. And these are trades that we put on the day before expiration, looking to close them out the morning of expiration day. And we like to use a lot of credit spreads to take advantage of the bigger time decay that's there, that close to expiration. And we put on two separate trades yesterday afternoon. We put one on SPY, which is the S&P 500 ETF, and we put one on QQQ, which is the NASDAQ ETF. The NASDAQ trade was part of our ETF service. And based on our analysis here of the chart, the yellow bars on our pulse histogram down at the bottom indicates price being between a 1 and a 2 standard deviation move on the upside. Doesn't mean price can't move higher. It just means it's not statistically probable. Odds favor a period of consolidation or a reversal in the other direction. That would make perfect sense, right? I mean, it's been a heck of a move higher on the NASDAQ. We didn't want to get ultra aggressive yet with long puts because price action hasn't confirmed. We just talked about that. But what we did do is sell a credit spread, which is a neutral to bearish position as long as you sell an out of the money call spread, which is what we did. It puts the time decay in our favor and allows us to lean bearish just in a safer way. It's a more forgiving trade. So here's what we did. Go over to the trade page here a second and we'll load it up. So we came in, we utilized the April 16 options, the ones that expire here at the end of the day today. We came in and we sold the 342, 344 call spread, meaning I'm selling the 342 call and I am buying the 344 call at the same time. We put this trade on here yesterday afternoon. We collected 56 cents or $56 per spread. It tied up $144 of our capital per spread. That's the most I could have lost in the trade. If I was dead wrong and price continued to move higher, we would have been out $144. Now, it hasn't been a huge move lower. The NASDAQ has been the weak name out of the bunch today, along with the Russell. But the beauty here is even with the NASDAQ, if you take a look at the ETF, QQQ is down 12 or 13 cents. Not a big move at all, but it is enough to allow us to book the profit on our credit spread. Anytime that we sell a spread, we are targeting between 50 and 75% of our max profit. So let me pull up the spreadsheet here and you'll see the trade down at the bottom. This is our trade right here. So we came in and we closed it out here today. We sent out an alert here earlier in the session. We said, okay, our target zone is if we can buy the spread back for between 14 and 28 cents. That's the ideal range because that would allow us to keep between 50 and 75% of the max profit. We are going to be able to book the profit sooner if we got a move to the downside. We did get a brief sell-off here earlier in the NASDAQ. It wasn't anything huge, but it did allow us to close out of the spread for 27 cents. That gave us a $29 profit per spread, $87 of profit, risking $500 or less. That's tracking our position size. And that's a 20% return on our capital overnight. Okay, so remember, we wanted to lean bearish. Ideally, we wanted to move to the downside. Did we get it? Well, we got it. I mean, but it's been very small. Only between a 14 and 20 cent sell-off here, depending on where the market's at. It's bouncing all over the place here. But, if you still held, let's say you held for the bigger profit. Let's say you wanted to get closer to the 14 cent level that I sent out in the alert earlier. It's currently trading for 25 cents. Okay, as long as price action stays below 342, which is the strike price of the option that we sold, you're going to be able to continue booking profit here. Highly recommend that you close out here before the end of the day. Keep in mind the index ETFs, the options trade until 4:15. There's an additional 15 minutes at the end of the day that you've got to account for. All right, so I highly recommend closing out ahead of time, taking the profit, freeing up the capital, not having to stress out there going into the close of the session. So nice trade there on QQQ. Again, we had 5 ways of making money on the position. We made money if the stock moved up, down, or sideways. It did not matter to us as long as price stayed below 342. We also made money from time decay adding up and from volatility decreasing. All right, so 20% return on our capital on the QQQ trade. The second trade that we put on was on SPY, and this was part of our overnight pop trade service. It's another one where we sold an out of the money call spread. Okay, price action very overdone on the upside. We were looking for a move lower. We put on a more conservative trade, just selling an out of the money call spread. It ties up less capital than just buying a long put. It also gives us those 5 ways of making money, like we talked about over on QQQ. So what we did here on the S&P 500 ETF, we came in and we sold this one right down at the bottom. We sold the 416, 418 call spread. We were looking for SPY to stay below 416. It's currently trading at 416.50. So we did not get the move that we were looking for. We had 5 ways of making money on the position. The move that hurt us was the fact that price has continued to stay above 416 all day today. We've had very little selling pressure to speak of at all. I showed you that 5-minute chart here just a moment ago. We've been stuck pretty much straight sideways all day. So I ended up closing out of the trade here earlier. I closed it out for 89 cents. It gave me a $33 loss on the trade. That's a 69% loss on that position. So it was a $99 loss overall on the position. So yeah, unfortunate. Didn't want to take a loss on the trade. Was hoping to give it as much time as possible. I'd typically like to close these trades out in the first hour to 90 minutes of the session. And in many cases, that's going to be doable. But with the market, the way it's been trading here today, I tried to give it as much time as we could. I gave it until early afternoon. Unfortunately, they just didn't want to head lower. So I ended up taking the loss, taking the partial loss, and we'll move on to the next trade. We'll see what happens here this afternoon, potentially looking at a new trade for Monday, which I'll walk you through in just a moment. Okay, so winner and a loser on the overnight pop trades from yesterday afternoon. All right, so let's talk about a couple of trades that are setting up for us here for next week. Since we're talking about the overnight pop trades, let's take a look and see if there's anything there for Monday's expiration. For those of you that are not aware, SPY has Monday, Wednesday, and Friday expiration. So we've got 3 opportunities to play expiration each week. So let's go ahead and switch this from QQQ to SPY. And let's take a look at the options that expire on the 19th. Let's open those up. My outlook has not changed. Okay, we're still massively overbought, still looking for a pullback to the downside here. So I'm going to take a look at selling an out of the money call spread. It's a little bit more challenging. I get questions on this. I had a couple of questions come in yesterday. Mike, why do you talk about the index ETFs so often with the overnight pop trades? Well, I love trading SPY because of those 3 different expiration cycles every week. But you've also got to take into account the liquidity, the volume and open interest side of things. If you take a look, a lot of stocks and ETFs these days have weekly options. They have options that expire on Friday. The problem with many of the weekly cycles is they are not always ultra liquid. There's not a lot of volume and open interest in those options, and it can make it more challenging to get fills. Products like SPY, QQQ, Apple, Facebook, they have very liquid options. I want to focus there because the fill prices make a big difference in our performance over time. Especially with a group of traders, when we send out our alerts, we're sending those alerts out to a whole group of people. I've got to make sure that there's enough activity there for everybody to get filled. All right, so we trade the index ETFs all the time, open to individual stocks as well. The challenging part there here recently is the volatility has just been non-existent. Because the VIX has been crushed here over the past few weeks, a lot of the implied volatility levels on the individual stocks have also contracted. When volatility gets low, the options get very inexpensive. And there hasn't been a lot of premium to collect on the individual stocks. That's why, again, if we can get a sell-off here, get some volatility movement back to the upside, it would start to open things up. It would give us more to do. It would start to open up a wider range of products to use as well. So just another reason why definitely want to see some selling here very soon. So let's go take a look at the out of the money call options on SPY. It's currently trading at 416.57. Okay, so let's go to the 417 calls. They're slightly out of the money. I'm going to right click on those. I'm going to go to sell and I'm going to select vertical. This is going to be a vertical spread. It's going to pop up an order down at the bottom where by default, it has me buying the 417 call. I'm sorry, selling the 417 call, buying the 418 call. I'm going to change that 418 call to 419. We are going to look at a $2 wide call spread. It's currently trading for 66 cents mid price. Okay, it's a pretty decent number. If I click on confirm and send here, we would be risking right around 2 to make 1. So very acceptable range, very typical for us. I'm typically in that risk 2 or 3 to make 1 range. So the goal of this trade here, if we were to put it on this afternoon, the goal is for SPY to stay below 417 going into Monday expiration. We don't care if the stock moves up, down, or sideways as long as it stays below 417. We make money. We also make money from time decay adding up, which we know it will, even over the weekend. Even though the markets are closed on Saturday and Sunday, the time decay is still adding up. That helps us. We also make money from volatility decreasing if it does. So we've got 5 different routes to follow to make money. Now, like we talked about a few moments ago on SPY, even though we have really good odds of success, it does not guarantee a profitable trade. We are going to have losing trades over time. But we know that long-term, we're going to win far more than we lose. So this, does it guarantee a profitable trade here? No, it doesn't, but we're stacking the deck in our favor. So the trade here, everything meets our criteria now. But at the time of this video, we're talking, it's 1:40 Eastern time. I do not want to place this trade now because we still have a couple hours to go before the close. I would rather wait to see, do we get a move between now and then? We've seen it here the last few Fridays. I mean, you get into that last 30 minutes of the session and we've had massive rallies going into the close. What I would rather do is, everything we just talked about to structure this trade, let's follow that same criteria, but let's pick it back up this afternoon. Let's see if we get a move between now and then. If we do, let's say we get another wave to the upside. I might be able to adjust my strike prices. I might be able to adjust this out to 418 and 420. So you can adjust the strike prices as long as you can collect. Ideally, I want to collect 50 cents or higher. That's really the minimum number that I want to see on these trades. I'm willing to go down to 45 cents if I can't get filled, but I really want to make sure I stay as close to that 50 cent number or higher. Okay. So this is a trade that's definitely going to be on my radar for this afternoon. I really want to get a trade on for Monday expiration. So this is one that I will be looking at here for this afternoon. Let's also take a look at some of the longer term trades. And when I say longer term, I'm talking about holding positions anywhere from 3 to 30 days. Now, I fully realize what's going on in crypto land, right? I mean, those of you that are trading the cryptocurrencies, I mean, it's just been unreal. I mean, so many of those cryptocurrencies are in bubbles. I mean, it's amazing. So it's taken, I think that's part of the reason why the market's been so slow the last couple of weeks. All of the active traders are trading cryptos right now because you just have some amazing moves happening over there. I do think we're going to start to see some normalization here, whether it be in cryptos or in equities. I do start to think, I think we'll start to get some of those much needed pullbacks. QQQ, just look at price. I mean, you take a look, it's been in an ultra strong move to the upside. The pulse indicator that we talked about earlier, still plotting yellow, still indicating an overbought extreme. So let's take a look here at potentially going out and selling a call spread. Now, the tricky part about this type of a trade is over the next few weeks, we're going to have earnings season really kick in. And towards the end of the month, a lot of the individual tech stocks will have earnings. Even though we're not trading Apple, Facebook, Netflix directly with this trade, they are a big part of the ETF. So we've got to keep that in mind. I'm not opposed to holding positions through earnings on the ETFs. I do not like to hold positions through earnings on the individual stocks. But the ETFs are fair game. So what we could do here on QQQ is go out to the May monthly options. Those are the ones with 35 days left to expiration. I'm going to go ahead and open those up. It is going to show us all of our options down at the bottom. We're going to go to the out of the money call options, and we're going to go out to the 348 call. Now, why? Well, take a look. One of the columns on my trade page is the probability out of the money column. And the 348 calls have a 65% chance of closing out of the money. I'm going to right click on those, go to sell and go to vertical. It's going to pop up an order down at the bottom. By default, it has me selling the 348 call, buying the 349 call. I'm going to change that 349 call to 350. stretched out to $2 wide. This one's currently trading for 79 cents. That's a pretty good number. I mean, that's a pretty good amount of premium that we can collect. Would I be okay taking that trade as is? I really would. Remember, on these $2 wide spreads, I really want to collect 50 cents or higher. So at initial glance, you're saying if I can collect 80 cents, why not? The higher the profit, or I'm sorry, the higher the premium that you can collect, the more profit potential you have. That may be true, but what I'm going to do here is I'm going to start to play around these strikes a bit. I'm going to move the 348 out to 349 and move the 350 out to 351. The further away from the current stock price I can get, the better off it is for me, the higher probability of success I have on the trade. Now, as I move farther away from the stock price, which I just did by $1, I go from 80 cents down to 74 cents. So I do give up some profit potential in doing that. I don't mind as long as I can collect 50 cents or higher. So let's change the strikes again. Let's go to 350, 352. Now I'm down to 69 cents. I'm going to make one more adjustment. I'm going to go to 351 and 353. That puts my premium at 64 cents. If I click on confirm and send, I'm right around risk 2 to make 1, right where I want to be. I make money 5 different ways, but 3 different ways directionally. As long as the stock stays below 351, we're okay. So up, down, or sideways doesn't matter to us. Price is currently sitting at 341. So we've got about a $10 cushion. It's already overbought, but it could continue to move higher by another $10 and we're still okay. So any move lower here is going to allow us to make money faster. If we don't move lower, if we just chop sideways, we're okay with that. We're also okay with a small move higher as long as price is below 351. We also make money from time decay adding up. Every day that passes over the next 35 days is going to help us. And we make money from volatility decreasing as well. Now, obviously this trade, selling a call spread, it's a neutral to bearish position. It's going against the prevailing trend. Now, I've had questions about this. I'm like, why are you fighting the trend? Why are you continuing to lean neutral to bearish here? The problem that most retail traders run into long-term, you get sucked into these massive moves, right? We're seeing moves that are very unusual. We're seeing historic type moves on many markets. And it's sucking in a lot of people thinking, hey, this is the new norm. We're only going to head higher from here. There's no fear in this market. Anytime that we get a dip, anytime that we get any type of selling, it's buy, buy, buy. Long-term, those of you that have been involved in the markets for years, you guys know this is not normal. It's not sustainable. Over time, we're going to get a washout move. We're going to get things to settle back into normal. And that's going to be painful for a lot of people. Okay. Now, do I want to just jump in and load the boat with long puts? No, that's not what I'm saying. But we want to make sure that we're stacking the deck in our favor. If we put on new bullish positions now on QQQ, okay, we're between a 1 and a 2 standard deviation move on the upside. Less than 13.6% of all occurrences will fall outside of this range on the upside. That's not a picture that I want to take advantage of on the bullish side. The numbers just don't favor that type of a move continuing. Is it possible? Yes. Is it probable? No. If you want to start to stack the deck in your favor, we know that even though we're going to have extremes like we're in now, over time, the numbers will always come back into line. They'll always start to normalize. And I think we're getting very close to that. That's why I continue to sell call spreads here. I'm trying to take advantage of what the market's giving us. Now, I mentioned there's one other way that we could potentially put on more of a hedging type position for those of you that might have bullish trades on. Maybe you have some capital to put to work. Another position that we could potentially take a look at, I've already got this on once, but I'm also taking a look at adding to it, is on the VIX, symbol VIX. If we take a look at the VIX, I'm going to take a look at the May 19 options. These are the monthly options with 32 days left expiration. Volatility has certainly contracted. Absolutely, no doubt about it over the past month plus. I mean, we have certainly seen the VIX go from historic levels on the upside. We've certainly seen it contract to down just over above 16 today. What you could potentially do is take a look at some long call options for the May monthly cycle. Now, if you were to do that, okay, you could potentially look at either the 16. You could take a look at either the 18. I'm taking a look at the volume and open interest here. You could probably take a look at the 18 or 17 calls. Okay. The reason I'm hesitating, I'm just taking a look at pricing and I'm also taking a look at liquidity. So when we go slightly out of the money, obviously we've got plenty of open interest, 5,000 contracts of the 17 call, 7,000 contracts of the 18 call, pretty good volume here today as well. So let's just say you went with a 17 call. Okay. Slightly out of the money. You're talking about $365 or so per contract. That would give you protection if the market does decide to roll over. If we start to see some selling in equities, if we start to see volatility start to pick up a bit, this would potentially give you some hedge against the move to the downside if you've got a bullish portfolio. For me personally, my overall portfolio is leaning bearish, absolutely. But I'm okay with that. And I'm also looking to add some VIX positions here, potentially into early next week. I'm not saying you got to rush into this trade here this afternoon, but this is another trade for early next week that would potentially benefit from a rollover to the downside in equities. All right. So I know a lot of you love the long calls and long puts. I do too in certain cases, but definitely want to make sure we have a fair number of credit spreads on as well. So that's a potential long call option position for early next week. All right. So any questions on any of the trades that I've talked about here today? Again, going into next week, we are certainly looking for a move to the downside. First half of next week, ideally. So leaning neutral to bearish here going into next week, just based on the overbought extreme that we have right now. So I'm going to start to wrap up here for the day today. Appreciate you all joining us here live. I'll be back here next week on Wednesday for our next midweek update. If you have any questions between now and then, feel free to email me directly, mike@netpicks.com. Otherwise, enjoy your weekend, everybody, and I'll be back with you guys on Wednesday next week for our next live session.